think about it, Jason, we all have access to the same financial tools. You, me, and the wealthy. You, me, and the super wealthy have the same access to the same financial tools. The only difference between us and them is they use the tools differently than we do.
Hearing infinite banking and that, sounds too good to be true. It often does sound too good to be true. We've had people talk about it on the show before. I think it's a really, really powerful concept. Would you just describe it for people?
This concept called the infinite banking concept, becoming your own banker, it is not a new concept. It's been around for over 250 years. This is what the rich and the wealthy use to build, keep, and create wealth.
Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I'm here with Brent Kesler. Brent was a chiropractor and chiropractic coach for over 14 years and then implemented the money multiplier. Brent became so passionate about how powerful the concept was, he began sharing it with others. So there's a whole lot of interesting stuff here in the bio, but as I mentioned, Brent, I think it sounds better coming from you. So first, thanks for being on the show. Thanks for taking the time out to chat with me today. I am very excited to hear your story and get to know you a bit. So thanks for being here.
Hey, thanks for having me, Jason. I'm excited to share with your community. I appreciate you having me on.
Awesome. Love it. Well, let's start with just hearing about you and your background and kind of what got you to where you are today.
Yeah, well, as you said, I was a chiropractor, so I'll take you back to those chiropractic days. I actually owned clinics in the Kansas City area. I had 5 clinics in the Kansas City area. I now am in Florida. I live in Port Orange, Florida, right next to Daytona Beach, about an hour east of Orlando. So I moved to Florida. I was actually, so in Florida, I was raised, so in Florida. And then I went to chiropractic school in St. Louis, ended up in Kansas City. So my wife and I became empty nesters back in 2017. So we decided to move to Florida. So that's home base, about an hour east of Orlando in Port Orange, right next to Daytona Beach. However, today I'm coming to you from the Lake of the Ozarks in Missouri, which is between St. Louis and Kansas City. We spend our summers out here at the lake. So we got about another month and we'll head back towards the end of October, early November, back down to Florida. But yeah, just to kind of give you the backstory, again, as I said, I had chiropractic clinics in Kansas City, and I went to a chiropractic conference back in 2006. And again, it was a chiropractic conference. It was all chiropractors that were there, and there were speakers. There were quite a few speakers, and this one speaker, he came up and talked about this thing called the infinite banking concept, about how to become your own banker. And I heard that information and I was like, man, that is really, really cool stuff. That sounds really powerful, but it just sounds too good to be true. And I'm sure you've even heard things like that in the past, Jason, where you, like the thing is where you watch something or you listen to a speaker and you're like, it sounds good, but it seems too good to be true. There must be a catch. Well, that was me at this conference in 2006. And after I heard all the information, I had gone home. I went back to my chiropractic life, and I pretty much forgot about that presentation. I just didn't keep it on the forefront of my mind. So then I go back to another chiropractic conference about 2 years later in 2008. I think it was the end of 2007, early 2008. And about 10 or 12 of my chiropractic colleagues that were at that previous conference with me in 2006 are now at this new one. And I guess they all assumed that at that time in 2006, just back when I heard about this concept of becoming your own banker, they assumed that I started it, just in my own life. They assumed I had implemented this financial concept in my own life, but I hadn't. So anyway, they were coming up to me. They were going on. They were saying, Brent, isn't that banking concept the most powerful thing ever to build, keep, and create wealth, to be able to pay off your debts, to recycle, recapture your money? They were going on and on about this, just about how this concept was working in their financial life. However, I wasn't doing it at all, right? So I thought to myself, there has to be something to this method. There's no way that 8, 10, 12 of my colleagues are lying to me. Maybe 1 or 2, but not, 10 or 12. So I came home and I told my wife, it was February of 2008. I said, honey, we've got to start implementing this concept in our financial life. And it was at that time, Jason, February of 2008, I was $984,711 in debt. That's what I owed to the third-party creditors. Now, I know what you're thinking. You're thinking, how do you even know that exact number? Well, that was part of the exercise. I had to know the amount of dollars, just that I was in debt. Now, let me tell you, that is a very painful thing to take a look at. Most people don't want to look at how much money they owe. But it was almost $1 million. And now you're thinking, okay, well, how do you get to be, especially a guy from Kansas, right? So how do you get to be almost $1 million in debt? Now, I know if you live somewhere like in California, Jason, in Southern California, that buys you a very small house in California for $1 million, right? Especially back then. Yeah. But in Kansas, it buys you a lot. Well, okay, so how was I in that debt? Well, I had the house that I lived in. I had that mortgage. I had my chiropractic student loans. At the time, I had two of my clinics, two chiropractic clinics. I also had the house on the Lake of the Ozarks, which I'm coming to you today from. And Jason, if I have a house on the lake, I have to have a boat and a wave runner, don't I? Yeah. Yeah, man, you can't have a house on the lake without a boat and a wave runner.
There's no other option.
Yeah. I'm also an airplane pilot. So as an airplane pilot, I had to have my own airplane. So it didn't take me a lot to become almost $1 million in debt. Well, I was able to apply this concept that I learned, and I was able to pay that debt off in 39 months, 3 years and 3 months. And all I did, Jason, is I added one step in my financial life. In other words, I didn't have to change my cash flow. I didn't have to, the thing. All right, so I didn't have to change my cash flow. I didn't have to work any harder. I never lost control of my money, and I never took any additional risk. I added one simple step in my financial life. And then I became really passionate about this. So I started teaching it to others in March of 2012. So here we are, fast forward 13 and a half years later, our company called The Money Multiplier. We have over 17,000 clients that we work with in every state of the country. We get about 160 to 180 new clients every single month. And now I just do the exact same thing, right? Just that I did in my own financial life. I just teach others how to do it. So that's kind of the backstory of how this concept began. And also I never, all right, so in 2017, I sold my last chiropractic clinic, but I have not been practicing myself in chiropractic since 2008 because I had associate docs that were in all of those clinics. And then in 2017 is when my wife and I became empty nesters and we moved to Florida. And guess what happened to the kids? Because right, the reason I stayed in the Kansas City area is because, so my kids wanted to be there. They wanted to finish school there. But then after they got done with school and we moved, as a matter of fact, I think we even moved, and my son was still a senior at Olathe High School, and my parents stayed with him for that last year during that school year. But then afterwards, all my kids moved to Florida. So now they're all in Florida.
They followed you to Florida. You couldn't actually achieve the empty nest, but
that's right.
That's all right. It's good to have family around. Well, I mean, very interesting. Interesting timing too, because 2008, most people know this, the great financial crisis. So certainly some interesting times to have been doing this. I guess where I would start with, kind of the concept of hearing this and hearing infinite banking and that, sounds too good to be true. It often does sound too good to be true. We've had people talk about it on the show before. I think it's a really, really powerful concept. Would you just describe it for people, let people know who are listening, kind of what that is that you're talking about?
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Yeah, absolutely. So this concept called the infinite banking concept, becoming your own banker, it is not a new concept. It's been around for over 250 years. This is what the rich and the wealthy use to build, keep, and create wealth. As a matter of fact, if you go out and you look up people like, just like people say like the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays, right? This is the concept that they use to keep, build, and create wealth inside of their family. If you go out and research how Walt Disney built Disneyland, how Ray Kroc funded McDonald's, how Pampered Chef got started before Warren Buffett bought Pampered Chef, this is the concept that they use. So it's not on trial. It's not being tested. It's not new. But most people don't really know about it because we're not taught about it. So anyway, so the thing that I would do for all of your listeners is I would start by this book right here. It's called Becoming Your Own Banker. This book called Becoming Your Own Banker, this totally changed my financial life. Now, the guy that wrote this book, he was my mentor. His name was R. Nelson Nash. R. Nelson Nash, he passed away at age 87 years old back in March of 2019. So about 6.5 years ago, right? But this book, this man completely changed my financial life. So he was my personal mentor through all of this. And now I'm just carrying along his legacy and I'm carrying along his teachings of what he taught. But even Nelson didn't create this, right? Because as I said, it's been around for well over 200 years. But the thing Nelson did is he brought this concept to us and he really broke it down in a pretty simple, easy to use, right, concept. And so most of us, could apply it. But even to this day, Jason, and I travel and I speak on this concept, whether I'm doing a live event or a podcast, a Zoom meeting, kind of like what we're doing now, a podcast. I mean, I do this 100 to 120 times a year, probably not as much in 25 because I have other people on my team that are out speaking on this, like on this concept. Like for example, my daughter, has a podcast called the Money Multiplier Podcast. She's out traveling around the country all the time speaking. She's in Jamaica today as you and I speak today. Last week or over the last couple of weeks, she was in Boston. She was in Altoona, Michigan. She was in Chicago. She was in Gary, Indiana. She was in St. Louis, Sacramento, and Las Vegas, traveling around teaching this concept to others. I got another guy on my team, Chris Naugle. Actually, Chris Naugle wrote a book with me. He was a client. Now he's a colleague of mine. And we wrote a book like 5 years ago called Mapping Out the Millionaire Mystery. Now I'm going to give that book to all of your listeners that want it. I'm going to give them the ebook version. All you got to do is send me an email, brent@themoneymultiplier.com, or go to our website, themoneymultiplier.com, and you can get that book, right? So the concept has been around for a long time. Obviously, I didn't create it, and Nelson Nash didn't create the concept, all right? So even though it's been around for a long time, if you think about people that we listen to in our financial life, our coaches, our advisors, even our parents and our grandparents, and, right, as far as our attorneys that are maybe tax attorneys or financial attorneys. So, all right, so anybody that we're taking advice from on the financial realm, you never hear them talk about this concept, because even out of all the traveling and the speaking that I do, hardly anybody has even heard about the concept when I first bring it up. Of course, as time goes on, more and more people do, but it's still a very, very low amount. I would say even if there was, 5% of the audience that I'm speaking to at any given time has heard about this, that's a big number. 5%. That means 5 out of 100 have, 95 out of 100 haven't. So why? Well, a lot of people think it's too difficult and complicated to understand. And if you think about the way we were taught, because I will tell you, Jason, back when I first learned about this concept and how powerful it was, and I saw how powerful it was, I was pissed off at my parents and grandparents for not telling me about it. But how come they didn't tell me? Not because they were keeping it from me. They weren't keeping a secret. They didn't know. Nobody told them. And if you really dig back and peel back the onion, and you think about, as far as just by our own family and people that are close to us, what we're taught about money and finances is what? The thing we're taught is to go get a good education, go get a good job, go work in that job for 30 or 40 years. And during the time you're working, we're taught to do what with our money? We're taught to put our money in a 401k, an IRA, a qualified plan, max out our pension, whatever all that stuff is, right? We're taught to give it to the financial advisors to let them be in control of it. And then down the road, we'll have a nest egg. Well, if you really think about that, it's not a very good plan, because number one, the thing we do with that money is whenever we put it in a qualified plan, 401k, IRA, right? The thing we do is we give up control of the money. Those plans never have any guarantees, right? There's no guarantee. Anybody in the sound of my voice right now, if you have a 401k, an IRA, qualified plan, even pension, that money is not guaranteed. That money is not guaranteed to be there at the time that you need to draw out of it, right? Actually, there's only one guarantee with all of that money. And that guarantee is it is guaranteed to never go below zero. And how much would that suck if that really happened and it went below zero, right? So the money's not guaranteed, and we are not in control of that money. So that's not a very good idea. And I would challenge every one of you that are on today. I want you to go ask 10 people that you know at retirement age. Okay, 10 people that are at retirement age. And I want you to ask them this question. I want you to say, hey, how well did your retirement plan perform for you? Your 401k, your IRA, or qualified plan. How well did that actually perform, just right, as far as for you? And they would probably say, well, not like I expected it to. And then if you would ask them a question and say, well, tell me everything you know about your retirement plan, your 401k, IRA, or qualified plan, they might be able to tell you if it goes up or down based on the quarterly statement that they get. And they may be able to tell you if it's invested in a low, moderate, or high risk category. But other than that, they don't know crap about that plan that they're in, right? So they're not in control. They don't know crap about the plan that they're in. So instead of us giving up control of our money, let's be our own banker. Let's have the control, and don't take any risk. Because remember, I don't want you to take any risk. I don't want you to work any harder. I don't want you to lose control of your money at all, right? I want you to keep that money in your family. So the banking concept, and the thing you're wondering, the thing you ask is, well, tell me what it is. What is this banking concept? Now I'm about to tell you what it is and what we're going to do to start our own banking system. And when I tell you that, Jason, I'm just going to warn you that we're going to lose about half of the audience that's listening right now. We're going to lose about half of them, because after I tell them this, they're going to shut down. They're going to totally shut down, because they're going to think, you know what? There's no way you can build, keep, and create wealth that way. I've heard about this. People have talked about it, and it's just impossible to do it. And I'm just going to challenge every one of you on here to keep an open mind and listen and to do your own research, because I'm not on here today to sell you anything or ask you to buy anything. I'm just here to give you the education of this concept and how it works for me in my life, and how it works for over 17,000 of just my clients, not including clients that aren't even my clients that do this method. But I want you to at least dig into the research and see, hey, is there something to this? Because what we want to do is use the tools that the wealthy have been using for over 200 years. So are you ready for it? Here's the product, the vehicle that we're going to use to build, keep, and create wealth. We're going to use a whole life insurance policy in a mutual company that pays dividends. There it is. I just said it. So I lost half of the viewers by telling them it was life insurance. We lost the viewers. They're now going to say, okay, I'm going to shut down. I'm going to go walk the dog, birth the baby, wash the dishes, turn on my favorite TV show. I'm done with this episode, with this podcast. There's no possible way I can build wealth with life insurance is what they're saying. I know there's not, because Dave Ramsey and Susie Orman said it was impossible. Well, let me just tell you that you do not know everything there is to know about this concept, because if you did, you would be implementing it in your own life right now. Now, keep an open mind as I go through this. I want you to think about who the number one purchasers are of whole life insurance in the world, who the number one purchasers are. Now, keep in mind, this is not any type of life insurance policy. No. This is not the life insurance policy that you go buy from your brother-in-law that sells life insurance. We all have a brother-in-law that sells life insurance. It's not that policy, Jason. No. It's not a term policy. It's not a variable. It's not a universal. It's not an IUL. It's not an indexed policy. No. This is a specifically designed, specially engineered whole life policy in a mutual company, very important, in a mutual company that is designed specifically for high immediate cash value. One more time, high immediate cash value. Now, what that means, Jason, is when you put money in this policy, you immediately have cash value. Now, okay, I'm going to tell you my definition, and anybody that knows me, my definition, anytime I say the word immediately, is within 30 days. So this policy immediately, aka 30 days, has cash value. So what that means is you put money into the policy, and now you're utilizing that cash value to go buy anything in your life that you want to buy for your debts, your expenses, your investments. It doesn't matter. Anything you exchange money for, you now are able to recapture and recycle that money. That money stays within your family. Now I'm going to go back to banks. Banks are the number one purchasers of whole life insurance in the world. They own more in whole life insurance, not term, not universal, not index, not IULs, not variable. They own more in whole life insurance than all of their land and their buildings combined. As a matter of fact, since 2013, since 2013, conventional banks have quadrupled their portfolio in whole life insurance. Now, why are banks, actually, before I tell you why are banks doing that, I understand that I'm sitting here flapping my gums and moving my lips, and you're like, okay, Brent, I hear you saying that, but how do I know banks are really the number one purchasers of whole life insurance in the world? Don't take my word for it. Go do your own research. Go Google something called BOLI, B-O-L-I. It stands for Bank-Owned Life Insurance, and you will see the hundreds of pages that come up on how much whole life insurance conventional banks actually own. And they're continuing to buy more and more. Now, why do you think banks are buying so much in whole life insurance? Is it because they're stupid, or they know something the rest of us don't know? That's right. They know something the rest of us don't know. So all we're going to do, Jason, all we're going to do is we're going to mimic and imitate exactly what the wealthy have been doing for over 200 plus years. That's all we're going to do. We're going to use the tools that they've been using. Because if you think about it, Jason, we all have access to the same financial tools. You, me, and the wealthy. You, me, and the super wealthy have access, the same access to the same financial tools. The only difference between us and them is they use the tools differently than we do. So now that I know how to play the game, I'm just going to use those tools that the wealthy have been using for over 200 years, which I've been doing, and I'm going to continue to build, keep, and create wealth. Now, I have 29 of these policies as we speak today. Now, I have 29, and I buy at least one policy every 1 to 2 years. And when you buy a life insurance policy structured for this concept, you, Jason, get to decide the amount of money to put into it. You get to decide how much money do you want to put in this policy? How often do you want to pay it? Do you want to start more? It's up to you the amount that you want to put in. And if you ever want to lower it, you can lower it. If you ever want to quit, you can quit. You're in total control. But once you start and you see how it works, you never want to quit. Now, I know I'm kind of giving you a high level right now today on this, but if your listeners go to our website, themoneymultiplier.com, I have a 90+ minute recorded presentation on there, and I go into a deep dive of how this concept works. And I go through different examples that you can print out and download that shows you how you can recycle, recapture money, how you can turn every liability into an asset, every depreciating asset into an appreciating asset. And okay, all you do is go to our website, themoneymultiplier.com, click Watch Brent Now, and you can watch that full presentation. So the thing we're doing is we're taking every dollar that goes out to other people. Because see, okay, Jason, the first thing that we have to understand or agree on, at least for a short time, agree on is what is money? What is the definition of money? So if I ask all your viewers, what is the definition of money, you would give me different answers. But all money is a means of exchange, is it not? That's all it is. It's a means of exchange. The thing we do is exchange food for money, money for food, car for money, money for car, house for money, money for house, right? All we do is exchange products and services for money. So on my presentation, and I'm going to do high level right now, I'm going to make believe this is a $20,000 bill. It's a $20 bill, but I'm going to make believe it's a $20,000 bill. And I do this on my presentation. I just use a $25,000 car. I'm going to use a $20,000 car. And I'm going to say we all want to go out and buy a $20,000 car. Now, the reason I like to use a car as an example is because most of us that are listening today understand cars. Because even if you don't own a car, I bet you at least have sometime or another in your life, you've at least driven a car or ridden in a car. So you understand what a car is. And a car is something we're constantly buying throughout our lifetime. Just think about the car that you're driving today. Is that the same car you were driving 5 or 10 years ago? Probably not. Is it the same car you're going to be driving 5 or 10 years from now? Probably not. Because we go through and we buy and sell cars because either they wear out or we get tired of them and want something new. So I want you to think about all the money throughout a lifetime that you would spend on buying cars. Not only for you, but think about your spouse, your children, your family, your future grandchildren. Think about all the cars that go through our family and how much money we spent on those cars. So let's say that we're going to go out and buy a car. Now, there's only one of three ways, Jason, that we buy cars. You, me, and everybody on this call. One of three ways. We pay cash. We either pay cash, we bank finance, or we lease the car. Because I know your audience are not thieves and they didn't steal the car, right? Well, okay, so possibly there's a couple shady ones on here, but most of them are pretty honest, right? They had to exchange the money for the car. They had to take this money, they had to give it to the car dealer, and the car dealer gives them the car. And that's how we've been buying cars our whole life, right? So we exchange money for the car, and everybody walks home happy. The car dealer has the money, we get the car, everybody's happy. But how about if there's but anyway, Jason, how about if there's a way we add one simple step in this process, and now not only do we get the car that we bought, yes, they still get the money, we still pay them the money, we get the car, but now we're recycling and recapturing the money. So we have the car that we bought, plus we have a system, a concept, and a method to get all that money back for the car. Would that be pretty cool? Yeah. That's exactly what I do. And if it's not a $20,000 car, then that's okay. Take off a zero. Then let's make it a $2,000 computer. Take off another zero. Let's make it a $200 pair of shoes. Take off another zero. Let's make it a $20 dinner. Add a zero. I know you guys, I know there's a lot of real estate people probably on here listening. Let's make it a $200,000 house. I'm a pilot, as I mentioned. Let's go down to the hangar in Camden Memorial Airport in Camden, Missouri. And I did this same thing with a $3.1 million airplane that's sitting in my hangar. I use this concept to buy the airplane. So not only do I get the airplane, but I recycle and recapture and get all the money back. So not only do I have the plane, but I also get the money back. Now, some people say, well, Brent, on these insurance policies, you get an X amount of return on your money. Well, dude, if I get all the money back, right? So the thing is, if I pay the money and I get the product, the car, the airplane, the boat, the bicycle, the TV, the chandelier, whatever I'm buying, if I get the item and I give them the money and I get the item and I have a process, a concept, a system to get that money back also. So what kind of return is that? I don't know, but it's all of it in my mind, because you get the item and you get the money back. Now, I know that sounds crazy. It sounds crazy and idiotic to recycle and recapture money. Well, listen, Robert Kiyosaki wrote a book. You guys know Robert Kiyosaki? He's famous for a book called Rich Dad, Poor Dad. All you real estate people that are listening, anybody that knows anything about real estate, I bet you know Robert Kiyosaki, unless you just got into real estate 2 weeks ago. But I bet you've heard of Robert Kiyosaki. Robert Kiyosaki is famous for a book called Rich Dad, Poor Dad. He also wrote another book called Second Chance. In that book, Second Chance, Jason, Robert Kiyosaki talks about this exact concept that I teach. He talks about it in that book, turning every liability into an asset, turning every depreciating asset into an appreciating asset. Another guy named Tony Robbins. Tony Robbins, you ever heard of Tony Robbins? He wrote a book called Money, Master the Game. Chapter 5.4 of that Tony Robbins book, Money, Master the Game, Tony Robbins talks about this concept that I teach. Exactly. The concept that I teach, he talks about it in that book. Now look, those are both great respected people. They're both great authors, very successful people. But when they write about this concept in their book, they don't do a very good job. And why don't they do a very good job? Because they make it too complicated and difficult to understand. So when you and me, and I won't speak for you, Jason, I'll just speak for me. When I'm the reader, I'm a very lazy person. I'm extremely lazy. When I read something and I get to a section that I don't understand necessarily, I don't necessarily stop and go back and try to understand what the author is really saying. I just go on and I keep reading in the book, and I never go back to really dial down and understand what they say. So in those books, they make it complicated and difficult to understand. And most readers, I'm going to just assume, are kind of like me, and they're lazy and they don't dial down to see what it really means. They just continue on to get through the book and to get as much knowledge as they can retain out of the book. Well, the thing I've done is I've just taken this concept, the infinite banking concept, which is what we call the money multiplier method. That's the name of our company, the money multiplier. And I've dumbed this thing down into a third grade level. I've really made it really simple and easy to understand. So when the normal person is just viewing it and they see it, there's either only one of a couple things that happen. They're either like, there's no way. That's too good to be true. Remember, that was me in 2006. I thought it was too good to be true. Or they're like, you know what? That kind of makes sense, and there might be something to this. Let me dig down and do a little bit more research. So that's my mission, is just to get your viewers to see, hey, there might be another way that I've never been taught of how to build, keep, and create wealth in my own family without taking any risk, without working any harder, without changing my cash flow and keeping control of the money, without ever losing control. And that's what we're doing, is we're teaching that concept. So in that presentation that I mentioned, right, if you go watch Brent Now on our website, I go through an example of how you get all the money back on all the cars you're going to buy, drive, and own. And I also show you, after you watch it, you will see how I paid off $984,711 in debt in 39 months without changing my cash flow. As a matter of fact, I don't use my exact example because it would take a little longer, but I use another real life example of a chiropractor in the state of Minnesota that's a client came to us and said, hey, I owe almost $470,000 to 12 third-party creditors. Help me get out of this mess. So we designed his system to where he was able to eliminate all of that debt in 61 months. And he did it with an outside injection of $25,000 a year. So he paid off, Jason, $470,000 of debt in 61 months, a debt that would have taken him well over 18 years. He did it in 5 years and 1 month, and he only injected $160,000 of outside money to pay off that debt because he kept his cash flow completely the same, didn't work any harder, didn't take any additional risk or lose control. He simply added this one step in his financial life. And that's very important for your listeners to kind of grasp here is I don't want you to change anything that you're doing with your money. All the stuff you're doing, if it's working and you're doing great, don't change and do something different. Keep doing what you're doing. We're just going to add an additional step. That's it. We're going to add something to what you're doing. And what that is we're adding where your money goes first. We're going to make your money stop one place first before you're going to utilize that money to pay off everything that you're doing. And I use this in my investment portfolio. I use it for every financial thing that I do. Like I invest in a lot of real estate. I own short-term rentals, long-term rentals. I own raw land. I own Airbnbs, VRBOs. I also do lending. I lend to private individuals for things such as cars and houses. And I lend to property developers, big development communities. Like I got one right now in Fort Collins, Colorado, and another one in Covington, Georgia, right? That I've lent the money. They're not my developments, but I've become the bank on those developments where I own a portion of those developments. For example, let's say if it's a 250 home development that's going up, I might own 10 or 20 of those homes because I've loaned, 5 or 10% of the total development cost. So I'm in first position of that development deal that, oh, by the way, are already pre-sold developments. They just got to get the homes up.
Right. Yeah. I mean, it's a great explanation. The three components, two of them make all the sense. The World Whole Life Insurance policy with high cash value up front. You said in a mutual company, and I guess I wanted to define what that means, I suppose. Most people get life insurance. There's probably a handful of companies that we think of, but what does that specifically mean for people trying to implement this concept?
Yeah. Well, again, so the reason it's important for a mutual company is because there's no stockholders or shareholders, right? So just think about when you go to even put your money in a conventional bank and the bankers are making all those big bucks, right? They're making the profits and dividends off of the money that you actually leave there because the bank itself really doesn't have money. The only way the bank has money is because you are the depositor and you're leaving your money in the bank and the bank uses that money. Now, let's talk about a bank because this is how banks do business. They loan money, okay? But they have to have money to loan. And whose money are they lending? They're lending the money that you leave there. So, and again, I go through this in my presentation. If I go put money in the bank and the bank pays me 4% interest on my money, okay, that's great. They pay me 4% interest. But now they're making money off of the money that I leave there. And how are they making the money? Because the money that I leave there is a liability to the bank because they owe me interest. So it's a liability. They have to so the thing they have to do is turn that money into an asset. How does the bank turn it into an asset? They lend it. That's what banks do. They loan money. So who do they loan it to? Well, they loan it back to us, the ones that actually deposited the money, because it's us that goes out and buys a house, okay, and it just gets a loan from a bank. We go buy a car, get a loan from a bank. We do a house remodel, we get a home equity line of credit from the bank. We use credit cards. We pay the bank back with interest for that, right? So the bank is making multiple times on our money. And I show you in my presentation how a bank makes 20% and we make 4%. A bank makes 20 and we make 4. Well, that's not just a 16% difference. That's a 500% difference. They make 500% on every dollar that we leave there. And if you don't believe me, go look and see how much banks actually make. They make between 400 and 1,300% on the money that you leave there. And again, don't believe my flapping gums or moving lips. Go to BauerFinancial.com, B-A-U-E-R, BauerFinancial.com. Pull up any bank that you want. Pull up any year that you want and see how much banks actually make on your money. So what we're doing in this method is we're being our own banker. We are now adding that one step, so it's a closed system. The money is not being leaked out. And how are we being our own bank? Because what we're doing is we're taking our dollars and we're putting them inside of our cash value life insurance policy. So we're sending the insurance company the money. Yes, we still have a bank account. We still have a bank account because we have to do online banking. We have to write checks, things like that. But we have a bank account for the convenience of that. Not right. So that's not where we store and keep and create our wealth inside the banking system, because inside the banking system, the profit holders and the shareholders of the bank make all the money. So what we're doing is we're putting our money inside of the policy, otherwise known as the insurance company, which is a mutual company, which is your question. And in mutual company, there are no shareholders and stockholders. We, Jason, own the policy contract. We don't own the insurance company. We own the contract. And what that means is we have first right to all of our money. So when we go in and knock on the door and say, hey, Mr. Insurance Company, I want my money to go out and do whatever I'm going to do, they have to give us our money. It's no questions asked. There's no loan approval or anything like that. We have that banking system built, and they have to give us our money in a timely fashion. Usually within 30 days, they have to give us the money that we request. So a mutual company means that there are no policyholders, there are no shareholders. We own the contract. Now, here's another powerful thing. Is when we use money. So let's just say if I put money into this policy, right? 10,000, 100,000, 1,000, whatever number that you want to put in, whenever you put money in there and you want to now use the money to go out and buy anything you want or invest anything, whatever you want to use the money for, go to Disney World, whatever, okay? And you now use that money, you, Jason, are not using your money that you put in there. You're not using your money. No. You simply put your policy up for collateral. You take a loan from the general fund of the insurance company. So you're not using your money. So what does that mean? You have this thing called uninterrupted compound interest. Now, I don't know where I'm at on the Google chart right now, but if you used to Google uninterrupted compound interest, my happy face came up on the first couple pages. I might be a little further down the line now. I don't know. I haven't done it in a while. Go do it. Go Google uninterrupted compound interest. And if you see my face or the money multiplier come up anywhere, right? So now what we're doing is we're going to take a loan from the general fund of the insurance company. All our money, Jason, is still in the policy. It's still in the policy, growing and compounding at a guaranteed tax-free growth rate plus dividends, and the government is completely out of our hair. So let me kind of dumb that down. So anytime we pay policy premium, you could tell me, yeah, Brent, I want to do one of those policies. I want to put in $100 a month. I want to put in $1,000 a month. See, I have over 17,000 clients that I work with in every state of the country. I think the lowest client puts in about $60 or maybe $80 a month. The biggest client, I think, puts in $540,000 a month currently. So you choose the number that you want to do. You choose. Pick a number between there and you pick it. And you can pay the premium monthly, quarterly, twice a year, annually. You can always lower the premium anytime you want. You're in control of how much money you want in your banking system. And now you put that money in this banking system. You access that money by taking a loan from the general fund of the insurance company, which is a great thing because you're never touching the principal of your money. It continuously goes up, guaranteed, not my flapping gums and moving lips telling you it's guaranteed. It is in your policy contract. Before you ever accept, sign, or pay for a policy, make sure you look at that policy contract and it's going to show you the growth rate. It's going to give you two columns, a guaranteed column and a non-guaranteed column. The only difference between those two columns is the non-guaranteed column is projecting the annual dividends because insurance companies are not guaranteed to pay dividends. Now, they are guaranteed to pay you a guaranteed growth rate, but dividends are not guaranteed. Now, with that being said, all right, I know a couple people are saying, there it is. That's the catch. The insurance company might not pay a dividend. Every insurance company I use, Jason, has been paying dividends for over 123 consecutive years without fail. Never in over 123. And I even have one that's been paying 187 years. Okay. So is there a pretty good chance that they're still going to pay dividends? Absolutely there is. They're not going to stop paying dividends. It's just not going to happen. But is there a chance? Absolutely. But there could be green Martians that come down and get me and take me to Mars as soon as we get off this call. So there's a chance. There's a chance. Okay. Just like there's a chance my favorite team, the Kansas City Chiefs, might not go back to the Super Bowl this year. There's a chance, not likely, but there's a chance. All right. So, but again, the thing that's so powerful is you're using your money at the same time it's continuing to grow, uninterrupted, tax-free. And on top of that, the thing we haven't even addressed today is that money is it's not just about the cash value in the policy. You also have a death benefit. Now, I don't usually talk about insurance and death benefit because again, my mission is to solve your need for finance and cash, not death benefit. But if you think about it, the death benefit is really the most important thing on the policy because you, Jason, me, Brent, every listener right now within the sound of my voice, we are guaranteed to die. Now, if you don't like the word die, then use pass or graduate. I use the word graduate, okay? It's not an if we die, pass, or graduate. It's a when. We all have an expiration date. And at the time of our death, now keep in mind, cash value continuously goes up, death benefit continuously goes up in the policy. It's not me telling you, it's in the contract. So what does that mean? Today's better than yesterday, tomorrow is better than today. So the cash value continuously increases, the death benefit continuously increases, and what we're doing, just if you really break this down and dumb it down, we are actually using, Jason, we are using a portion of our death benefit for our own financing needs while we're living. Instead of most life insurance, what we're doing is we're leaving the full death benefit to our beneficiaries. So why not use a portion of that death benefit while we're living? And as time goes on, you're using more and more of it because it continues to go up. Cash value continues to go up. So let's use the money ourselves. Let's use the money ourselves instead of waiting till we die, pass, or graduating and leaving that money to our ungrateful children. Or am I the only one that has ungrateful children? No, just kidding. My kids are great.
I'm sure you're not the only one. I'm sure the plenty of kids out there. Well, Brent, I mean, this is great. I in the interest of time, I want to kind of skip ahead and let's talk about, sort of how people can connect with you. What's the best way for them to reach out? How do we obviously you mentioned your book, but let's talk a little bit about how people can get involved if this is something that's interesting to them.
Yeah, absolutely. And again, I think we should do a part 2 sometimes too, because there's so much on this topic.
Yeah,
right?
Absolutely.
But
absolutely.
So the best way is go to our website, www.thebalaraview.com. moneymultiplier.com. So it's THE moneymultiplier.com. You can also send me an email, Brent, BRENT, at themoneymultiplier.com. I would encourage your listeners to go watch that 90 plus minute recorded presentation. We also have 70 plus other short videos on there as well. Also, my daughter, she's very active in teaching this concept. She teaches it around the country. Just go watch her podcast. She has the Money Multiplier podcast. And Jason, maybe you and her should exchange podcasts sometimes, right? Her name is Hannah Kesler, 26 years old. So go watch her podcast. And then I would also tell your listeners, look, go out and Google the Money Multiplier. Go Google my name, Brent Kesler with one S. Don't take my word for it. Go look at the hundreds of success stories, testimonials, the plan designs, the case studies, right? Just go, so go out and see what the people are saying about how their financial life has changed by implementing this concept. Now, the last thing I'll say is, look, you guys are wondering, you're like, okay, Brent, you got to get paid. You tell me you're not selling anything. So what is the catch and how do you get paid? Well, there is not one really. Well, actually, there's not one at all. But just because I know somebody wants to know how I get paid and how I make money. Well, I get paid never by you, the client, never by you, the client. I get paid the same way your car insurance guy or gal gets paid. If you go to John Smith, the Allstate man, to buy car insurance, the check that you write is not to John Smith. You write it to Allstate, and Allstate pays John Smith a commission. I am a licensed life insurance agent in every state of the country. So if you decide to implement this concept in your life, hopefully you'll do it with us at the Money Multiplier. We will be your servicing agent. Why do you want us as your servicing agent and not your brother-in-law that sells life insurance? Because your brother-in-law doesn't understand the concept and he doesn't know how to design the policy this way. And even if he did understand it, he doesn't want to design it this way because he has to take such a significant hit in his commission. And if he tells you that he will do it and that he understands it, then ask him why he hasn't told you already about it. Why are you telling him about it and he hasn't told you? So the way I get paid is a commission from the life insurance company, just like your auto guy gets a commission from your auto insurance policy. I don't decide the amount of commission I get paid, and you, the client, doesn't decide the amount of commission that I get paid. It's determined by the insurance company. So hopefully you'll work with us if you're going to do this concept. Now, let's say you just don't like me, you don't like my tone, you don't like what you see. I mean, that's fine too. I want you to do this concept whether you work with us or not. There's other people that you can go work with, but I will tell you there's nobody on this planet that offers you the tools that we offer you, such as the tools once you start your policy. Just for example, the cash flow analysis, the money multiplier map, the gains projector, the debts blaster, the tools that we provide you that we customize for each individual client based on their individual financial needs and goals. We provide those tools for you, and you never pay us a dime for any of those. You never pay us a dime. So that's how I get paid, is a commission off your policy. You will never, ever write Brent Kesler or my company, the Money Multiplier, a check for a dime.
Fantastic. Well, we'll put all of that in the show notes so people can find you. I think it's really is a fascinating concept, and I think very powerful. So, Brent, thank you for being on the show. Thank you for sharing everything. I think there is a ton more to learn about the topic, so I think we can all check out that. I'm sure the video on your website would be very helpful. But yeah, thank you for being here today. I really, truly appreciate it.
Well, hey, Jason, thank you for having me. I know you have a choice of many, many guests on your popular podcast here, but I appreciate you just having me on. And again, I'm here to serve your community in any way that I can.
Thank you so much. And people listening, make sure you connect with Brent, check out his website and the book. And as always, thank you for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?